This week, President Obama had the opportunity to announce tax cuts that would have really made a difference to the economy. What he did announce is accelerated depreciation on capital investment, which is good. You can't take away from that. That's a good. That's a good tax cut. But what he didn't do to help spur job growth is he did not announce a payroll tax holiday for a minimum of 2 years. That would cause companies that are sitting on the fence right now to go out and possibly hire because they don't know what healthcare costs are going to cost them. But if they're able to make up that savings on the payroll tax, then perhaps they'd be willing to make the jump and begin to hire again. He failed. He refused to announce it. He failed. So you have to feel bad for those that are out of work because they have nobody in Washington as of right now that's representing them that's in the majority. So hopefully that's going to change this November. But really, for those that are short right now, and I know a lot of people that follow me are short, and you really need to be careful. I'm going to go into that in a minute. Secondly, Christina Romer, as we all know, resigned and went back to Berkeley, the liberal breeding ground. Thank God, goodbye, Christina Romer, because she never had a good thought in her life, with the exception of going back to teaching. And who did we bring in? Austin Goolsbee from the University of Chicago. So we have another Obama night from the University of Chicago, and we're going to have to deal with this guy. Austin Goolsbee is in, another academic. Expect nothing new. Let's face it, folks. There are some serious problems that are facing the Democrats, and they are the party in power. They control both houses of Congress. They control the presidency. So never underestimate the power of the Congress, or the presidency, or the party in power. They truly do have the power. Now, before I go into where we're going to go, let's go back to where we have been, because that's important to this conversation. Let's take a look at the RTH. This is a daily chart of the retail holders. Now, let's take a look. Let's go back to February through April of this year, 2010. And you can go back on my YouTube videos. You could hear me probably every week from this time period go back to a chart of the RTH and say, this is just completely impossible. What's going on here? It's just not realistic that this rally is for real, because it wasn't. And I said that this sector was going to break, and was going to break hard. Now, in hindsight review, I was correct. We were short this position all the way down. Why was I so bearish? How did I know that the RTH was being manipulated? It was easy. There was no volume. There was no volume to support this sector. And as it went ever more extended beyond its 50-day moving average, we knew that the collapse of the sector was going to be all that much more ugly. So we took a large short position in the RTH, knowing of what's going to happen. We averaged in day by day, week by week. We added more to the position until finally it collapsed. We had a great profit on this trade. We need to close this out because more than likely what they're going to do is they're going to continue to spike this higher. Now, what we're seeing again, take a look at this. You had this double bottom formation, bottom down here, came back down, retested W formation. That's a very bullish pattern. Now, you've had the past week or so, actually more than a week, of positive trade. But there's only one problem, just one. Besides the fact that the consumer is dead at this point in time. We'll get to that in a moment. There's no volume, folks. We've gone back to there's no volume. During the sell-off, there was plenty of volume, plenty of red bars. Yes, there were some counter-trend rallies with some big buying, big black bars that came in here, but only to be faced with selling. So here we are what's old, as in back here, is now new, and you can get ready to see them to try to spike this higher on ever decreasing volume. So why am I bringing this up? Why is this important to the Democrats in Congress? It's because there's no way they are going to revitalize this economy. It's impossible, especially by election day. It's not going to happen. But what they can do is they can manipulate the stock market. And if they can manipulate the stock market and people see their 401k statements that they log on every night, and they could see that their 401k statements are growing, and the president keeps coming out and saying the economy is recovering, then you know what? By de facto, okay, it must be growing. They're not sophisticated investors. All they're trying to do is put money away every week, and hopefully it grows. And if their portfolios grow, the Obama administration knows that the more likely they are to go vote for him because something's got to be going right. And that's what they're pinning their hopes on right now, is dirty tricks. But I'm here to tell you, it's just not going to hold up. It's not going to hold up. So let's move forward. Let's take a look at the S&P 500. I sent out a video to my subscribers on Thursday of last week, Wednesday of last week, and I told them, be careful. I'm sorry, it was Thursday last week. Be careful that I sent out an email early in the morning. Don't short this market because they spiked the market higher, and the previous day's volume was extremely low. Don't put it past them to try to spike this market again, which they did on Thursday. They spiked it. The SPY, the Spiders, which is the ETF of the S&P 500, opened above its 200-day moving average. I received emails. Do we add to our short positions here? My answer to them was no. Don't touch this market. Let's see if it can hold 200-day moving average by the end of trade on Thursday. It failed. It wasn't able to hold it. What did they do on Friday? Again, they spiked it. How was the volume? There was none. This is manipulation here, folks. This is manipulation. Tried and true. It's got the fingerprints of the manipulation all over it. So be careful. As much as I wanted to add to short positions, I couldn't in good conscience do it. We were short of the TZA. We took profits here. We did begin to add more back here. Very small position. Very small position. What I'd like to do, and what I expected to do, is I expect to see us to retest the, say, 30-50 level, which is the lower band of the rising uptrend line. Then perhaps we'll join back in high now. We are heading into an election where the Democrats are bound to lose a lot of seats. It's just about how many will they lose. They need to spike this market. The transports are signaling that this market should be dropping. They insist upon trying to spike the transports. The traders aren't buying it. You see topping tails here. This is a harbinger for bad things to come. And take a look at Goldman Sachs. I mean, I've been saying this to my members for the past couple of weeks now. Take a look at this. It looks like a sick child. This is the leader of the banks. Look at it. It's below its 50 and 200-day moving average. The 50-day moving average is curling down. Its volume to the upside is absolutely pathetic. I don't even know why they bother opening up the stock anymore. It's just pathetic. They have to get rid of their proprietary trading operations. They have the biggest oil desk in the world. The thing you need to ask yourself is, as these banks rally and these new legislation goes into effect, where will their earnings come from? The shadow inventory of houses they have on their balance sheet? No. Proprietary trading desk? No, because that's been limited by the new Frank Dodd bill. The two thugs that got us into this position, they slapped their names on the legislation. So don't expect much out of these banks. So I'm urging you, be careful to the long side here. I'm going to go into detail with my subscribers on the members edition of the week ahead commentary of where we're going to be trading to the long side and what we're going to do to the short side. So if you're interested, sign up for the 14-day free trial offer and don't get burnt in this market. It's critical that you be smart and not get sucked in by CNBC and the talking heads on Wall Street and on TV. They want you to buy stocks. They want you to buy stocks because these money managers who are on there, they're not compensated on their returns and what they do for their investors. They're compensated on how big their portfolio is. So they need new money coming in all the time. Why do you think they don't come on? You're not going to see a Mario Gabelli come on CNBC and say that he's bearish. That's crazy. That's crazy. He would never do that. Compensation dictates behavior. Compensation dictates behavior. So if you're wondering why these money managers are all bullish, it's because they're compensated on the size of the portfolios that they're managing, not by their performance. So you can listen to them or you can listen to me. I'm a lot cheaper. So please sign up for the 14-day free trial offer. Enjoy the rest of your weekend, and I will talk to my members later on with the week ahead commentary, members version. Thank you. Talk to you soon. Bye-bye.